Welcome back, everyone. This week, I'm going to read you a piece from my Substack publication, and the link will be in the description below if you want to go and visit it and read it for yourself or click on any of the embedded links. So, a quick overview. This is going to be about In Defense of the Magnificent Seven. And this piece, we'll get into it at the end of this article, but a quick overview is that I'm really getting irritated and tired of people dumping on the Mag 7 and tech stocks in general, and I don't like how it is reflective of animosity, negativity, and just being hater focused. And this is something that I've been wanting to put pen to paper, so to speak, on for a while and get it off my chest and process my emotions on it. So here we go. Let's get into this. In Defense of the Magnificent Seven. Haters gonna hate and ain'ters gonna ain't. If it wasn't for the pesky Mag 7, I'd have beaten the market. Mag 7 is the newest version of what started out as FANG back in 2013. FANG became FANG with two A's, which then became FANG Man, and now we're speaking of the Mag 7. And ever since the genesis of FANG, people have been hating on them, and each and every year, people call for their demise. If I was an inadequate and inept individual looking to obfuscate and detract from my underperformance, I'd hate them too. Just look at this 10-year performance. Here you have the SPY in the last 10 years up 216%, Google's up 398%, Apple's up over 1,000%, Amazon's up 676%, Meta's up 532%, Microsoft over 1,000%, Nvidia up 13,000%, and Tesla is up 2,455%. If you're new to markets or forgetful, you might say, yeah, well, looking at that chart, they're only outperformed since the COVID era of easy money and transaction-free trading. Okay, let's look at a chart from January 2013 to January 2020. Well, what do you see here? Yet again, the SPY, S&P 500, is at the bottom of performance at 164%. From 2013 to 2020, January to January, Tesla was up over 1,000%, Nvidia was up 2,000%, Microsoft 600%, Meta 700%, Amazon 662%, Apple 353%, and Google 287%. Normally, I would say just look at the chart and read it for yourself for sake of brevity, but I really want to emphasize the performance of these companies, so therefore, if you're not aware, that's normally how I would read something like this. But if you're new to the channel, then please understand that I'm reading these percentage returns, not perfectly accurate, but more than I normally would, just to generate that emphasis. So, what's your next excuse for dismissing and disqualifying them in a thought-terminating cliche fashion? While playing around with the chart, I surprisingly found that the SPY has outperformed 3 of the 7 names on a 3-year time frame. The SPY has outperformed Tesla on a 3-year time frame, Meta on a 3-year time frame, and Amazon on a 3-year time frame. What irritates me is that no one in my camp wants to give the devil his due. This has been a phenomenal place to be invested for the last decade with secular tailwinds in their favor. Most money managers woefully underperform the SPY, let alone the Mag 7. By blaming the Mag 7 in an intellectually dishonest way through a chain of narrative spins in order to justify their underperformance, they are able to coerce their investors or themselves into staying invested. You sure as hell can't just return the money back to your LPs and tell them you suck. The narrative is something along the lines of, I'm underperforming the benchmark because the benchmark has been hijacked by a handful of names, and that handful of names are trading at a, quote, crazy valuation. Therefore, it is not my fault that I'm being a reasonable custodian of your capital and as such underperforming. The implicit supposition of this is that if people weren't crazily buying unreasonably priced equities, then there would be more money to go around and to buy their undervalued names and stocks. It also presupposes that there aren't companies outside of the Mag 7 which are doing quite well and are reasonably priced. FYI, there is. Also notice the qualifier being used, crazy or illogical, in an attempt to relatively contrast and compare themselves to by implying that they're sane and logical. People are more tricky than most give credit to. So let me ask you this. Why are they underperforming the equal weighted index? Question mark, question mark, question mark. Of course, such a question goes against the grain of such a heavily eschewed, convenient narrative and would force culpability. You can only come to these sorts of realizations when you keep constant your comparisons and control for variables. The SPY in the last 10 years has performed 212%, total returns, dividends, and all. The RSP, which is the equal weighted index, is up 168%. How many fund managers haven't even performed to 168% in the last 10 years? Why didn't these money managers own URNM, XHB, Short China, etc.? What you come to realize is that they always have a reason for their underperformance. It's misdirection at its finest. Why are they running a 200% gross? Why are they running at 200% gross, yet are only 50% net long? All year, they've been talking about how the equal weighted index is flat on the year. They use that as evidence by proxy to excuse their underperformance. But so what? What does that have to do with anything? When did the equal weighted index become their benchmark? Or are they implicitly using that as a proxy to justify their underperformance? There's always some reason. It's not a one-off. It's always interesting to hear people bemoan late-stage capitalism and then act surprised that increasing concentration is occurring in the S&P 500. They talk about corporatocracy, socialism, crony capitalism, and banana republics, but then don't buy the very names that are in bed with the government and would benefit from such forms of government. They don't buy the names who benefit from regulatory capture. Isn't that the sort of mode that their demigod Buffett is always talking about? It doesn't make much sense to me. Here they are laying out the playbook for late-stage capitalism and how they're always talking about how emotional and groupthink obsessed people are, and then when that's expressed to its logical conclusion, they are taken aback in a ghastly fashion. Huh? How did they miss the trend? For the last decade. Along those same lines, people talk about how the markets are rigged, in which I almost always respond the same. Then that means there's a fixed set of rules, so find out what they are and then play by them. But that's when you find out that their conspiratorial minds is all about generating fantasies to provide cope and fallacy. Because when the big names go down like they did in 2022, there's a new conspiracy about how the fat cats are dumping on the innocent peasants. Then when the markets go back up in 2023, the newest rendition of their conspiracy is that 2022 was to make the peasants sell to the fat cats so the fat cats could buy them for cheap. They put forth unfalsifiable claims which always seem to validate their ineptness and victimhood. They also seem to pay no mind towards the inconsistency and contradictions of the narratives they put forth. As often is the case in life, people want to give you one side of the story. They'll show you a chart like the one below. This is a chart depicting the weight of the top 10 stocks in the S&P 500 by percent. The average over the last 35 years is 20%, meaning that the top 10 names in the S&P make up 20% of the S&P. Then the peak during the tech bubble was 25%, and we're currently at 32 to 35%. But then they fail to mention charts like this. More with less. Workers needed at S&P 500 companies to generate $1 million in revenue. Back in the 1980s, it was 8 employees to generate $1 million in revenue, and now it's sitting at roughly 2 employees to generate $1 million in revenue. As a side note, of course the chart above gets depicted as increased efficiencies through technology and how we're becoming a service-based economy. What I rarely see mentioned accompanying these sort of charts is how inflation impacts those numbers. If it takes 8 people to generate $1 million and inflation goes up 100% over the subsequent years, then those same number of employees, all else being equal, would be generating, well, that's wrong, $2 million. Is it because they're more efficient? Is it because the company has pricing power? Maybe. Or it could simply be inflation. Well, the same works in the opposite direction. It will only take 4 employees to generate $1 million after a 100% inflation. Guess what? We've had nearly 200% inflation since the beginning of the chart. And just like that, voila, you have a scary chart that's fallen by 75%. Yet another reason to keep constant your comparisons and control for variables. Here's a more intellectually honest chart that depicts it adjusted for inflation. And it's sitting at, we'll call it 4 or 5 employees to make $1 million. Back to my point. There's real reasons why the Mag 7 has experienced the rip-roaring bull market they've been in for over the past decade. They're practically monopolies in their respective domains, and they absorb any competition that steps into their territory. They've had numerous years of solid growth, solid margin, they have strong balance sheets, strong bands, and economic scale. But no, that all gets looked over. I'm not saying that any of this is sustainable. Lord knows I wouldn't call this a new permanent plateau, but people don't even try to explain what has led to it. Nope, just shit on it like any good hater does. Like any good subjective emotionalist, they point and sputter and manufacture indignation. As the above chart demonstrates, the disparity between normal times and now is an additional 15% of concentration. Normally, the top 10 names make up 20% of the S&P, and we're currently sitting at 35% concentration in the top 10 names. So they're actually complaining about 15%, not 35%. But 35% is a bigger number and validates their narrative. Matter of fact, I've seen this sort of misleading representation of numbers before. Here we go. Yes, President Biden. Folks, right now, 25 of the largest pharmaceutical companies in America control 70% of the market. This lack of competition drives up prices, making it harder for hardworking American families to access the health care they need. Depending on how you want to spin a story, you could also say 70% of the market is controlled by 25 companies with an average market share of 2.8% per company. But they don't represent it that way. I wonder why. While writing this article, I came across the following tweet. Don't buy state-owned South American oil companies. Socialism something or other. What excuse do the hedge funds have in not owning those Latin American stocks? See, the problem with ideology is that it causes you to arbitrarily lump things into one of two categories, in-group and out-group. It also forces the possessor of the ideology to be woefully ignorant and personally incredulous. This is what leads to calling Colombia, Panama, Brazil, etc. socialist communist countries. The consequence of that is you miss out on opportunities by committing voluntary, unforced errors. Now, compare these Latin American oil and gas producers to the performance of the Mag 7 within the same time frame. So let's zoom in on this. You have Ecopetrol up 66%, PBR up 108%, and YPF up 135%. In that same time frame, Apple's underperforming those names, Google's underperforming those names, Microsoft's underperforming those names, Tesla's underperforming those names, and Amazon, Nvidia, and Facebook are the only ones that are in line with similar performance in the last year. So, that's worth thinking about. What prevented money managers from outperforming their benchmark or even the Mag 7, since people want to treat them the same even though Mag 7 is only a third of their benchmark? Why didn't these money managers own EC, YPF, PBR, etc.? Ideology, that's why. ESG ideology. Blatant mislabeling of Latin American countries as communist ideology. Recession preoccupation dogmatism. They've missed it, and by it, I mean their benchmark, and by a wide margin. Doom. We've all seen charts like these. Record concentration of market cap in 5 largest stocks. Yeah, except that's from 2020. Or S&P now more concentrated in the 5 largest stocks than ever. Also from 2020. But so what? What actionable insight are you deriving from these charts? And there's really no need for people to be nasty about it. And just as I pointed out with the Biden tweet, you can frame the above graphs differently too. Positive, negative labeling of an attribute is expected to evoke positive or negative aspects of what's being labeled. In the medical field, attribute framing posits that patients are more likely to choose a treatment when it's framed positively. Just imagine if I said you had a 20% chance of dying. Alternatively, I could say that you have an 80% chance of survival. Which treatment would you choose? It's a trick question. They're the same treatment. Add a picture to the narrative and your work is done. This is from a 2018 article. Here you'll see on the right side of the pie graph 5 names making up half the pie and then a bunch of tiny print pointing to the rest of the sections. The article goes on to explain how the majority of the money made in the markets comes from a handful of stocks. Well, no shit. It's nothing new. It's called the Pareto distribution, and it is a very real phenomenon that governs our universe in numerous domains. As much as I'd like to talk about that, it's beyond the scope of this article. To sum it up, look at this chart. Distribution of excess lifetime returns on individual, here we go, let's zoom in. Distribution of excess lifetime returns on individual stocks versus Russell 3000, 1980 to 2014. And what you'll see is that only a small minority of stocks have any true meaningful outperformance, extreme winners as they call them. And it's not a normal distribution. You'll notice the very long tail. And winners win, because if you notice in the extreme winners section on the right side of this chart, you'll see barely any bars, and then the very farthest right bar is a big bar. And you're like, huh, what's that about? You know, this is the top 0.1% have as much wealth as, I don't know, whatever the number is, 90%. But the amount of wealth that the top 1% has in relation to the top 1% is also quite different. So, similar phenomenon at play. The Pareto distribution is a law that governs any creative productive system where their fundamental underlying measure is human productivity. And the law goes like this. A tiny minority of people will make the large majority. The difference between an individual artist, athlete, author, etc. and a business is that an individual has until they die, yet businesses can keep going and going and going. People seem upset that the Mag 7 has been in the good graces of the Pareto distribution, but I digress. Then you have disparities in the charts, which adds to the confusion. Look at 1990 in the below two charts and tell me which is correct. This chart shows that in 1990, the top 10 weights as a percent of the overall index is at roughly 21%. But then you look at this chart and it's at roughly 40%. So which is it? Did 1990 have 40% or 21% concentration in the top 10 names? Hell if I know, and I don't really care. My time and attention is a valuable resource, and I'm not quite sure how I'm supposed to generate returns with this sort of information. Am I supposed to short it? No thanks. Am I supposed to get all hot and bothered by it? No thanks. Then layer on a chart like the one below, and you have yourself a solid alibi for doom. U.S. equity valuations need to fall to return to fair value. I guess this is positing a case, or you're supposed to infer a case for a lost decade of stock performance. But stock performance means what? Market performance? Which market? That's the problem with these things. I'm going off script here, but that's the problem. We say you'll have a lost decade. In what sense? In what names? In every single stock? Like, maybe, but like the 70s, you could call that a lost decade, or from 2000 to 2010, you could call a lost decade, or a couple solid decades in the Japanese markets. But if you were in particular sectors in the Japanese markets, it actually bottomed out rather quickly. And same thing with the tech. And what about dollar cost averaging if you're just a normal person? From the 2000 bubble that crashed, that went back up, and then in 08 it crashed again, and they call that the lost decade. But if you were dollar cost averaging, did you really lose? But, you know, that involves context and not a simple narrative, but I digress. Don't player hate, congratulate. That's what I say. If you like to have your emotions riled up and manufacture indignation while pointing and sputtering, I'd recommend curling up on the couch and watching The Bachelor. The financial markets aren't the place for that sort of nonsense. And no, I'm well aware of all the problems and misdirection occurring in these names, that being Mag 7. One of my favorite tweets and charts on the topic is the following. From Koifin, the free cash flow yield of big tech if you exclude stock-based compensation. It's quite the disparity between stock-based compensation and not stock-based compensation, and that's a point of contention between quote-unquote value investors and quote-unquote growth investors, because why not have some false binary dichotomy in exaggerative terms? But it's a point of contention. I'm well aware of it. If you're a person who's into the Mag 7 or tech stocks, you do you. I'm not going to knock your hustle. Get it how you can. If not, fine. I look at stock-based compensation. If you don't care about it, or you factor it in differently and you have your reasons, the next one, like, whatever, man. Whatever. No reason for me to do a whole tweet storm belittling and demeaning people for it, though. And that's the crux of my problem, and thus this article. Haters gonna hate, and ain'ters gonna ain't. I'm sick and tired of hearing this subtextual, bitter, resentful, jealous, straw-manning mockery of the Mag 7. It's such an unhealthy, obsessive fixation and preoccupation for certain people. Many of my peers have this sort of absolutist rigidity towards wishing for the downfall of tech stocks, and I find it repulsive. I would say it's comical if it wasn't so tragic. It doesn't resonate with me at all. The only time I think about the Mag 7 is when someone else brings it up. When it comes to the Mag 7, Chamath says it best for me. That is below my line. I take vengeful fantasies very seriously. The warnings were provided to us by Cain and Abel. That's an entire article unto itself, but I'll sum it up. Cain's sacrifices were rejected. This made him bitter towards Abel's, whose sacrifices were accepted. He developed a pathological fixation towards Abel in a jealous rage. Cain felt unappreciated, marginalized, and alienated. He then acted on his vengeful fantasies to destroy the symbolic representation of the ideal, Abel. It's classic displacement and lessons going unlearned. So you might be asking, how does this apply to the financial markets, which is what this article and practically all my publications are about? An investor doesn't make the right sacrifices. Sacrifices could include doing due diligence on the company or sector, not position sizing correctly or expressing the theme in the right way. Just imagine being bullish uranium for a multi-year period and then buying monthly call options with all your capital. They didn't sacrifice the time to learn why that's a bad idea. Sacrifices can include not following along via the 10Q or conference calls. They don't sacrifice the parts of themselves which are inadequate to the task of making money in the markets, such as impulsivity, short-sightedness, being result-oriented, not establishing a proper decision-making process, and adopting mental models that could aid them. Over time, they observe other stocks going up, for no good reason, they'll tell themselves, of course, while their own portfolio underperforms. Instead of wishing for themselves to do better, they wish for the downfall of the stocks that are doing well. Instead of finding out the why behind the what, they cling to Copen fallacy to adjudicate themselves as being righteous and thus by necessity the others as sinful. Unlike Cain, they can't destroy these other stocks though, so they might try to express their grievance by shorting them to feel good about themselves, capitalizing on the downfall of those stocks. But they fail at that too. Inevitably, these people rage quit or burn through their capital. They'll go on to talk about how the stock market is rigged, and they'll generate all sorts of conspiratorial narratives. These people fail to realize what Shakespeare noted some time ago. The fault is not in our stars, but in ourselves. A poetic way of expressing this is the following. People rather stand downwind of a fire cursing God for the smoke and soot they're breathing in, rather than moving upwind of the fire. Meaning that people don't mobilize and orientate themselves in the world to better position themselves. Instead, they stay static and stagnant, blaming some external, existential, malevolent predator for their victim status. The willful blindness required for this is quite the burden to bear. There's nothing more dangerous than a bear case. The reason is simple. It sounds too good to our ears. I've seen marvelous and brilliant sounding bear cases for why the markets were to fall, but it rarely ever happened. The argument was so convincing and sweet to my ears. There's all kinds of reasons why the market shouldn't have gone up after '08, yet it did. The reason is simple. There's all kinds of reasons that the market should have gone up. After all, it did go up. There's something about a bear case and how it attaches to our egos and our desire to feel validated that I find extremely dangerous, at least to my portfolio. Haters in the face of context. In a simplified way of viewing the world, you can say that there are value investors and growth investors. By the way, I hate those labels, but it is what it is, so let's just move on. The camp that I squarely fall into is the value investors, but neither side is without its faults. I notice a lot of anger towards the growth investors in my camp of people. Interestingly enough, I don't see much of that sort of hate towards us from the growth investors. People who indiscriminately hate tech stocks are bigots. I always recommend being wary of anyone who prays for the downfall of someone else. A Cainish heart is not one that you want to make friends with. A bigot is someone who holds an unreasonable prejudice against an individual based upon their affiliation and membership to a group. You might recognize this by the phrase guilty by association. In the context of today's piece, it follows the following logic. Any and all tech stocks are bad for the simple fact that they fall within a broader category known as tech stocks. And what does this mean for me? Personally, I own a company called Town Square Media, TSQ, by the way. I would consider them a tech company. What I want to know is, why are these people calling for the downfall of Town Square Media? This is when these haters will start to add context. They'll say, it isn't all tech stocks, just the ones at stupid valuations. But not so fast. That's not what they said. Then they backpedal and engage in adding context to clarify. This is what you might call in-group fighting between me and one of my, fellow peers in my echo chamber. But just imagine how the balls-deep tech investor feels about this. They were never afforded any clarity and context. They just had someone wish them immense suffering as a consequence of stocks they own. Too late for clarity, bub. It's this unnecessary division and so-called politics in the investing community that I find unpleasant. The irony is that these same value-oriented investors are acting in a hyperbolic, emotionless fashion and then have the audacity to complain about how people in the media or in the political realm are doing the same thing. It's an interesting juxtaposition. Normally, the value investor camp has a bunch of anti-liberal, anti-democratic party people in it, yet here they are in real time acting like one of the people they despise. They're engaging in identity politics to cause a rift through hyperbolic misrepresentation. The irony. You can think of the Mag 7 as the popular kid, charming, smart, attractive, and gets the pretty lady that the haters can't. So what do people do? They mumble under their breath and run their mouths and talk shit. The beta males rejoice when they hear bad news about their enemy. Think, for instance, tech company coming under scrutiny of European antitrust litigation. Oh yeah, they'll get what's coming to them. Yeah, down with them. Everybody needs a whipping boy and scapegoat. It's never resonated with me to have celebrity fixations. It's never resonated with me to pay such close attention to a handful of stocks that I have no interest in. The haters are not objective, dispassionate observers. Their motives are sinister and born from their copulation and entertainment with the devil. In other words, they're pissy and sour. The After Hours segment. This article has been an idea for a while, yet two things prompted it into being created. The amount of shitposting I've seen on Twitter in the last 2 days since Powell said his remarks about interest rate cuts and all these value names have skyrocketed for a couple of days, Wednesday and Thursday primarily, with a pullback on Friday. So all that shitposting that happened, and then they juxtaposed it with the NASDAQ falling. Yeah, it's time for value to outperform tech crap, and just all these little remarks. These little backbiting, heel-nipping behaviors. And then this article was also prompted by a couple of podcasts I've listened to lately. To sum up the tweets I've seen lately, observe the following image. The second reason was me being triggered by a couple of comments made while listening to podcasts. Let's look at a loaded question formatted in a false dichotomy with a lack of understanding of what logic is. It's important to note that this is coming from a person who claims to help, and I quote, guide you through the analysis of market trends in search of opportunities unfolding within major sectors. Then once blank, as I'm keeping his name private, then once blank has narrowed down the sector or industry, he analyzes the price action across dozens of charts and indicators to find the opportunities within the biggest profit potential, end quote. All I know is he chronically talks with a negative connotation towards the Mag 7. Is his trading course trading these names in an attempt to, and I quote, hit financial home runs or take paper losses, unquote? I sure as hell would hope so. It's been one of the biggest themes and most profitable sectors of the year, and for that matter, the decade. I also find it odd that he doesn't provide evidence of his trade and portfolio performance. I mean, if I was, quote, prolific and innovative, end quote, I would want to show you my, quote, asymmetric approach, end quote, via my performance history to convince you to buy my course. Hell, I show you and I've claimed none of these things. The secrecy around people's portfolio performance has always been an alarming red flag to me. It's simple. Show your 1, 3, 5, 10 years, or however long you've been at it, percentage returns. I'm not asking for names or some proprietary investment strategy, just the percentage returns. Why is that too much to ask? But back to the podcast remark. Quote, the markets really have almost been fragmented because there's the Magnificent Seven that are bulletproof and keep rising and defying all logic in terms of some of the valuations they're reaching, yet it is the trade that is working. And any prudent investor that is looking at things from a value or growth and trying to diversify is simply getting chewed up as the performance in the market has not been broad. What do you make of the Mag 7 and where we are in general in equities? Do you view it as a true bear market risk, or do you view it as the markets will trade in a sideways range until valuations normalize? First off, end quote. First off, others and myself haven't been getting chewed up. We're up double-digit percentage points for the year. Sure, our performance has been lacking in the second half, but I wouldn't call double-digit percentage gains on the year chewed up. And why are the outcomes constrained to down or sideways? Why can't Mag 7, go up, which I did not write this, but why can't Mag 7 go up more? First of all, why is the default supposition that it won't? But other than that, why can't Mag 7 stay flat and 65% of the market go up? Or why can't Mag 7 fall while the rest of the market disproportionately catches a bid and thus pushes the market higher? I'll tell you why. And it's not because of some back-tested historical example. It's because the common denominator for such a biased and loaded question is just that, bias. It kind of looks like valuations are normalizing, does it not? The high flyers are coming down or are within their historical range. This chart is the PE for the last 12 months. Let me zoom in on this. This would be the Mag 7. So just looking at the pardon the unprofessionalism here, if you're still watching. So a lot of these, Google, Meta, Apple, Microsoft, they're all within a historical range. You could say it's the higher end of the range, sure. Then names like Meta have actually come down over the years in their PE multiple. Other ways to value a company, but everybody likes the PE multiple. So on a 12-month basis, those names seem reasonably priced, if you wish to call it that. I know some people will contend, what do you mean by reasonable? I'm not trying to have that argument. You could just say they're within a historical range. And then you have names like Tesla that are, I'm not really sure why the chart only starts in, anyway. Then you have Tesla's coming down from its highs. Nvidia's come back down. Amazon's coming back down. So it seems like it's already kind of happening, or has already happened. And then you have the PE for the next 12 months. So, yet again, you could say things like Tesla is actually in the lower historical range from 2014 to, current. So, I mean, at one point, the forward was, my goodness, 300x. But anyways, I just don't understand Google valuation, Meta valuation. You could say that they're no longer growing. You could say this. I mean, you can make all kinds of arguments. But for the comment was in the quote, valuations to come down. But it kind of looks like they're within a normal historical range. So think of Monster. I didn't do this. I'm going off script again, but Monster, I think, gets down to like a 28 PE historically over the last 10 years, and that's as low as it gets. But it keeps growing, and it's, I think, 5x'd in the last 10 years. But it's one of the best performers in the stock market on the long run. So you could say growth is slowing, but then there's new markets and this and that, and you could say, well, what's the asymmetrical risk reward? I'm not trying to get into all that. What I'm pointing out here with these two charts is that it seems to me, just by looking at these charts, that the valuations have already come down. Back to reading. Yes, I'm aware that Apple has had a multiple re-rating this year from 20x to 30x, and all the while they're comping negative quarter over quarter or year over year. But they're also buying back stock to offset that. Let me guess, that doesn't count. If you believe that, then the degree of pathological delusion and detachment from the structure of reality and the stock market which you possess is beyond my talents of helping you. All a company needs, assuming all else being equal, which is a dangerous assumption, is to buy back stock. Point in case, a coal producer. This is Alpha Metallurgical Resources, ticker symbol AMR. And you'll see that the stock has been doing quite well, actually. And yet, their EBITDA over the last 12 months has been coming down. But the price to earnings multiple has been going up. But if you look at the shares outstanding, I think they're buying 30% or bought back 30%. I mean, they're buying back a lot. Like, a lot. So, although Alpha Metallurgical Resources EBITDA has been declining over the last 12 months, their share repurchases have more than offset that. Yet I see the value investors promoting this and condemning Apple. But they're doing the same thing. But AMR gets a pass because it's trading at a 6.3 times PE, and I would suspect, most importantly, it falls into the in-group of stocks for my echo chamber. And yes, going off script again, there's a big difference between 30 times PE and 6.3 times PE. I'm well aware of it, but what I'm trying to get here is that buying back stock can really help a lot. And when you have a lot of attention to a stock and a lot of money chasing that stock, and it's permissible by your shareholders and so on and so forth, due to the propaganda and ideology and ESG requirements and all that nonsense, then there's, first of all, a equity premium over private companies, but then there's varying premiums for varying companies. Coal stocks probably will never, or for only a short period of time, ever trade at a 30 PE. They're cyclical, they're this, they're that, they're smaller cap, blah, blah, blah. There's all these reasons why certain companies trade at higher. You could say that the fundamentals mimic one another on some level of analysis, but then one stock trades at a higher multiple than others. All you have to do is look at the US premium for names. Just imagine if Alphamine, which is a tin producer, uplisted to the New York Stock Exchange. All of a sudden, it would trade at a higher multiple. All else being equal, the multiple would go up on the stock. The PE ratio would go up. I digress. I just don't get, this is a rhetorical, sentimental statement. I just don't get why people are so obsessed with Apple. I don't get why they're so hateful towards a stock that offers such a great trading opportunity. If you're into those sort of things, that is. Quote, defying all logic, end quote. The real kicker here is he provided a logical explanation to why they're valued the way they are in a podcast that he did a week earlier. Sure, he provided a partial and heavily biased answer that provided an incomplete picture that refused to address the merits of the question he was asked, but nonetheless he outlined the inferences that formulate people's ideas which create the logic they use in their argument, as well as a general overlay of the sociological patterns that people conduct themselves in. People pretend for some reason that informal logic isn't logic. As I have insisted multiple times in my writings, The logical validity of an argument is a function of its internal consistency, not the truth value of its premises. On to the quote. When a major trend is underway, those people who are in the trend will always find a reason why it's happening. So when Tesla's ripping to the upside, everyone's going to be driving an EV car, and that's the future. When the agricultural stocks are running, everyone will say, everyone's got to eat. There's always some reason they come up with to justify what the trend is, but the market always does what the market always does. It's all about flows. And when everyone gets too crowded into one trade, inevitably there will be a turning point and the trends mean revert. I'm not saying that that has to be devastating or anything, but I'm saying that this idea that the Mag 7 keeps running relentlessly and because of this they'll never go down is nonsense. The markets will always correct. That's the way it is, and that's the way it will always be. Now, going off script for a moment, what he said everything in that statement is true. But if you've listened to my other videos, then you will know that simply saying true statements isn't necessarily enough to come to a true, applicable conclusion and solution. But I've covered that in other videos. This is what you call an emotional response to a question. He's answering a question that wasn't asked but was tangentially associated. We've all done it. I've done it. Matter of fact, it's quite a good clue to enlighten yourself about how sensitive you are to a topic. Let me explain with an example. You're tired of your boss taking advantage of you. You come home and your spouse innocently asks you to do something, and you rip into her. After it's all said and done, you ask yourself, where in the hell did that come from? You come to realize that you've been extra sensitive to requests as they often come from your inconsiderate boss and that you're feeling unappreciated and abused at work. It's only when you unload on your undeserving and unsuspecting spouse that it forces you into conscious awareness. In the case of the podcast, it's merely revealing to me that he has a strong bias in a certain way. It's not a moral judgment, but an observation. You must know the bias of the people you seek counsel from. I'm sure he's irritated and bothered with all the stock promoters grandstanding in the media. I'm sure he's concerned with the naive investors who pile into these names with some utopian expectation. He might be irritated that his trading portfolio is being shadowed by the Mag 7 performance. Ultimately, I don't know. My point is that in the initial quote, he said that they were defying all logic. That's a false statement. It's a common enough practice of humans to substitute words or phrases which carry a certain connotation, although it's factually untrue, in favor of using correct words based upon their denotation. But hey, humans are humans. The problem is that it's a trigger for me. An interesting juxtaposition to this is, when a major trend is underway and it rubs your senses the wrong way, you'll always find a reason why it shouldn't go up, and yet it will. And you'll be suspended in disbelief as you get your face ripped off trying to repeatedly short it based on valuation, as though valuation is the only variable to consider. Just ask anyone who was short Nvidia going into 2023. Now, I'm not accusing him of that. I have no idea whether he's made money on these names on either the long or short side. I purposefully left out who this individual is. He's a cool enough guy and I'm not trying to start any beef. I also think he's a net positive for the investing community and therefore am under no moral obligation to say his name. Ultimately, I think I can get away with quoting him because not enough people read or listen to my work. If I had a larger audience, I'd probably leave this out. Along those lines, I actually have another article I want to write about what a famous person said on a podcast, but I'll save that for another time. With that, I'm done. I've said enough and hopefully I've made my points. This is something I've been wanting to get off my chest for some time. Hope you enjoyed it, and if not, it was a cathartic experience for me. So with that, I am done with this article and on to my weekly stock performance. So here we are, cash is building as I've been meaning to do. As I noted earlier in the video, Powell talked about interest rate cuts, and that got people all excited. And then a lot of these quote-unquote value names rallied really hard, 10, 20%, some of them. And then, obviously that helped me because that pretty much is the category of the stocks I own. Uranium kind of lagged for the week, even though the physical did well, but the miners didn't do quite as well. I'm pretty much just not staring at the screens too much. You do that, you start playing with your emotions, then you overtrade and blah, blah, blah. I kind of feel like the actions I've put forth the first 11 months of the year are going to determine whether I outperform that. Right now, I'm outperforming the S&P, but if things don't go well in the next 2 weeks, then I won't be. Interestingly enough, my echo chambers barely made a mention of it, which is interesting in itself. But the IWM, Russell 2000, made a 52-week high this past week. And then the Dow hit a record high, barely any mention of that. And then the NASDAQ made a all-time high, no mention of that. And then the S&P is a couple percentage points away from making an all-time high. So it's funny because all these people my whole echo chamber went crazy when the COMEX opened up and gold was at a all-time high, and then they went quiet real quick the subsequent days, which is interesting too. And I guess exaggerative emotional response when something exciting happens, and then when it doesn't, you just quiet. I see this a lot. Like, no one's really talking about offshore oil right now. Like, what happened? Like, they couldn't shut up when it was doing well, but then it plateaus or starts doing poorly, and it's a ghost town. So then they just jump to something else. Well, now they start, I don't want to say pumping, but emotionally hyping or whatever, bragging, whatever you want to phrase it as, about uranium, or they talk about this sector or this portion of their portfolio, and then they stop talking. Like, well, why are you only talk about what's currently working? Like, isn't that interesting? Wonder what that's about. Of course, I'm being rhetorical about this, but I've already talked enough crap this video. I really don't want to keep being negative. So some of the names that did improve partially was like Tidewater. I'm now, I think from last week to this week, I'm up 10% on that. Sibanye, I'm up almost 15% on that. Palladium ripped like 15% in the past week. My best performing stock now is Kinross, up 42% on that. And then Transocean, that's been for 10% of my portfolio, I'm down 10% on that. Honestly, this is all about transparency and honesty and communicating, so I want to do that. And I was thinking about this, and so I wanted to share it with you. So it goes like this. ATI. So I might make a video on this, even though I was going to just give some opinion pieces that weren't directly stock related, but tangentially associated to financial markets, about the aerospace and defense sector, and then the niche, sub-niche industry of alloy metals, titanium, nickel alloy, things like that. That's what ATI does. And it pulled back some, and I bought. That's why I own some. It's 1.65% of my portfolio, whoop-de-doo. I bought some. Why did I not buy more? Well, let me tell you what I wanted to do. I wanted to sell Franco-Nevada and DRS, Leonardo DRS and FNV. I wanted to sell those two because I'm less excited about them than I am the alloy sector. But I didn't, as you note, because it's on the screen. Why did I not do it? Well, it's complete result-oriented thinking, and it's not a good decision-making process. And that's why I wanted to share it with you, because it's an unforced error on my behalf. I have arbitrarily drawn a line at December 31st for yearly performance. We all do that for the most part. And I'm window dressing, if you will, my portfolio. And I'm no longer concerned about outperforming the market on this arbitrary short time frame, but concerned about underperforming it. And as a consequence, if this was June or September or March or not November or December, I would have sold DRS and FNV, and I would have bought more ATI than what I did. But I was concerned that I might keep pulling back more. And as such, I didn't buy more. And so here I am sacrificing long-term gains because maybe ATI rips. It's up 7% since I bought it. Now there's another name I wanted to buy as well that I've seemingly is not going to pull back enough for me to buy. And so that was kind of my justification. And I also thought with the FNV that gold's doing well and it might break out. And if it does, then FNV won't be that bad of a performer. Like, I don't want to just sell it because it's down and I don't like the negative emotions that creates. I was going to sell FNV because I think that these alloy names will provide me better performance next year than FNV will. That would be the correct decision-making process, which means I should have sold it and bought ATI. Had that cash been, because the way you need to think about it is if that FNV was in cash, so if I had $111 in my account sitting in cash, would I have used those proceeds to buy ATI? And even then, the answer might be no. And the reason is because I'm trying to not underperform the market in the short time frame versus massively outperform the market in a long time frame. And, you know, it is what it is, and there's reasons for that. I want to, this is the first year of this channel. This is the first year of Cup of Coffee Capital, and damn it, I want to get it off to a good start. And sometimes person's psychology comes first over the money. And by being myopic and acting with expedience and short-termism, I might be able to outperform the market. Now, that's being result-oriented is what that is. Because, like, I outperformed the market, but it was not the best decisions that led to that. Now, in reality, the answer is the bulk of the decisions were the right decisions, but just that was that very last decision was a poor decision. And, the funny thing is now Franco-Nevada's up roughly the same amount that ATI's up over the week, so I haven't lost out yet, but I suspect I will. As a consequence, there's an opportunity cost in there. But I think it's important that I outperform the S&P, and I'm not trying to YOLO gamble some trades into this or that. I actually almost bought, this is one of these things I'm talking about. If it was any other time besides November or December, a couple of weeks ago, I almost bought Zim, ticker symbol ZIM. It's a shipping company, and it's, oh my God, that stock is, that's a tough chart to look at. And I almost bought some for a rebound, just a trade. And had I done that, I would be up 25% right now on that name. Now, of course, I would only make it a couple percent of my portfolio, or would have made it only a couple percent of my portfolio, but I didn't do it because the risk was that it would break down even further and go against me. But I know that it's a decision-making process based upon probabilities, and over enough iterative trades and periods, it's a profitable short-term trading strategy, let's just say. Or at least it's enough to entertain me and give me positive emotions and keep me busy. And I didn't buy it because I was concerned of the downside risk, which is a good decision-making process, and less concerned about the upside reward. But that was predicated strongly and influenced by it being end of year and me trying to show a beat to the S&P, my benchmark. So as a consequence, I didn't buy it, and as a consequence, there was an opportunity cost in this iteration of the game I'm playing of 25% so far, in which I would have sold it because the Red Sea always having some drama in it that's causing ships to reroute and this and that and blah, blah, blah. And so it's bullish for the shipping containers and such. So that's why it's rallied so hard. It was up 18% on Friday. And so I missed out on that. So I just wanted to share that with you because it's corrupt and pathological thinking that's short-term time focused and result-oriented, but I do feel justified in it. Will I do it next year? Perhaps not. I want my first year to beat the market, you know? I mean, just like, if I have to explain why, it's beyond words to me. It's like, it's obvious. Like, I want to beat the market. Now, of course, you could say I could be a stalwart of, and a real practitioner of what I say and say, I don't care about any given 365-day period that just so happens to fall conveniently within a calendar year. And I generally don't. And I actually was kind of shocked by my behavior and became cognizant of it and realized what games I was playing that was unbeknownst to me. And well, it's quite interesting to observe yourself doing something and you're unaware of it. And then you figure out how you're doing it and why you're doing what you're doing. So that's all interesting. So with that, I think I've gone on long enough. So thank you for watching, and until next time.